Hey guys, Toby Mathis here with Infinity Investing, and today we're going to go over a much more detailed look at whether you should rent or buy under any number of circumstances. I'm going to show you a calculator that I use and an easy way to kind of come to a pretty good idea of whether you should be renting or you should be buying. Now, I'm going to say this as a caveat. If you're buying, you really should be looking at it as a forever home, unless you're very explicit about saying, here's how long we want to live here. So like if you're going to live in a home and you say, hey, I'm just going to temporarily live here, try to put a time frame on it so you can make intelligent decisions about whether it's a good idea. Because here's the thing about houses. If you sell it, you're giving up 8 to 10% of the value because you might be paying 6% for commissions and other costs to do the transaction to actually sell. Plus you have to move. It's really, I always kind of just say, just figure 10% is thrown away. So if you buy a house and you think the market's going up and you think, hey, great, and maybe it's going up 5% a year. I know a lot of you guys think it's going to go higher, but let's just say that it's 5% a year, which is about historical. It's right around 4%, 5%. So let's just say 5% a year. It's going to take, you buy a house and 3 or 4 years later, you're giving up almost all of it when you sell. So if you're selling every 3 years, you're running in place. So just be really deliberate about it. This is a house that I'm going to live in forever, or this is a house that's temporary, because that's going to have to go into your equation. Now, let me just draw this thing out. I'm just going to kind of show it. My face will go away, but my white screen will come up. And so I'm going to say, should I rent or buy? And we'll just come up with some numbers. Let's just say you have a house that you could buy for, so you could buy it for 300,000. Let's say you could get a loan. You're gonna have to put 20% down, whatever your scenario is, but we'll just put 20% down and your interest rate. So let's just say the interest rate is 3.5% because we have pretty good interest rates right now. Right. Now we're going to compare that with what you could rent it for versus rental. And we'll just put $1,500. Oops, not 150,000. That's the tax lawyer me adding zeros to everything. Can't help it. Right. All right. So the first rule that I'm going to use, actually, I'll just draw this right across. I'm going to use what's called the 5% rule, or the rule of 5%. And what that says is we take the purchase price and you multiply it by 5%, which is 0.05, which is going to get you to $15,000 a year. And this is what we would term your out-of-pocket costs. So if you're going to have this thing, and I'll go back to that screen in a second, but I'm just going to stop it. So this is your out-of-pocket cost. In other words, your unrecoverable cost. So if you have interest, if you have property taxes, insurance, repairs, things that are leaving your pocket, and we're not talking about paying the principal down, that 300,000, we're talking about just the interest. So in that scenario, I bought a $300,000 house with $60,000 down. So I had a $240,000 loan. So the interest on that loan. There's also some opportunity value that I'm missing on the money being tied up in real estate, especially residential real estate. It tends not to grow as fast as the stock market. So for example, you're looking at the growth on real estate's generally about 4%. The growth in the stock market's generally historically about 7%. So there's about a 3% spread. So you start adding all those things in, and you figure out it's going to be on the lower end, somewhere on that 5% range. So I use that as like kind of a starting point to see whether I really want to dig into this further, but it's a good rule of thumb. It can also be used to figure out the value of a company, because you could reverse engineer it saying, hey, if I wanted to figure out what the value of a house should be, I might take the amount of rent and multiply it and divide it by 0.05 and come up with the fair market value too. So I can go both ways on that one. But this is getting us, go back to the screen so you guys can see it. This is going to $15,000 a year. I'll get my handy dandy calculator out. and I'm going to divide that by 12. So it's a monthly amount of $1,250. So I'm really comparing $1,250, the value of buying versus a rental of $1,500. Keep in mind that I had to put down, I'll put a different color, that's $60,000. But this, all things being equal, I'm probably going to be better off to buy this, but I'm in the ballpark. I'm probably gonna be better off to buy this. It's a little bit less expensive to buy this particular piece of property. Now, I'm gonna pull up something else. I could do the calculator on this one and we could get a little more specific. So I like to use ranges. So I'll go back and plug in the numbers. So I have price per my house is 300,000. I'll put in my down payment. And this is my little cheat sheet. So maybe someday we put it on the internet. And we have a $1,500 rent. So that's accurate. So I'm just looking and I'm plugging in these numbers and it's doing the calculation for me. So I'm looking at unrecoverable costs. I'm actually using kind of a calculation that I use in rental real estate for maintenance and things like that, because I'm actually looking at the real cost. Like I know that the 5% rule is going to tell me it's about $1,250, but I can get much more specific if I start getting my actual tax rate and the cost of insurance. And I'm looking at whether it's a new home, 10-year home, 20-year home, 30-year home. So I'm using an older home maintenance cost, but I could change that up. I have a calculator that I could just change that up and say, hey, you know, if it's a new home, it's going to be closer to, I'm just going to plug in, I ran a test on a little bit over 100 houses, and it was about 1/10 of the cost of an older home. So I could get this down. Now I'm right. Oh my gosh, I'm right in that ballpark. Like I'm literally at the same number. So then I can come down here and I can compare A to B, and I just have simple rules. If A is lower than the range of both values in B, then rent. Well, it's not. If A is higher than the range of both of B, which there's the 5% and the real monthly cost, then buy. They happen to be identical. I didn't mean to do that, but that gives you an idea of just how close we are from an accuracy rate. So that tells us that we should be buying this house. I then reverse engineer it once again when you have a tie, like when you're close. So let's say that our rent was $1,250 a month. I'm going to change that just to change these numbers up. Now it's a much harder question. We're kind of tied. We're in the range, but there's no clear winner. This will tell us what the value of the house is. The 5% value of the home is 300,000. The investment value of the home is 243. I'm probably going to rent it under those circumstances. So if that rent was a little bit lower, you'd probably rent, but with it being higher, that rent being 1,500 and that being fair market rent, you can go to Rental Meter. You could go to Zillow and start getting an idea, or you could just ask a realtor in that marketplace what the rents are for homes in that value. You can get a good idea of whether you're paying the right rent. And then that tells us, yeah, we should probably be buying this. And then the value of the home under the 5% rule is 360,000. The investment value, which is if I was going to turn this into a rental, is still 292.5 or 292,500, which means I am assuming that I'm paying a lot more on that house than what I'm actually paying. I actually use a 35% operating expense. So my net operating income is only 65%. It would actually be higher if I didn't have as much maintenance. So I'm right there. And I'm factoring this as making cap rate of 4%. I could say, hey, only if I'm making 7%, then it starts to drive it down. You can see how these things work. So if you're an investor, you know what I'm doing. I'm saying, let's find out what the cap rate of the area. Right now, the major players, the BlackRocks of the world, are going for 4% cap rates. A very aggressive investor is going to go for 7%, but I can start playing around with that number. But in this particular case, again, I'm looking at it going, man, it looks like those rents are just a little bit more than what it would be to buy this property. And so I'd probably be going the buy route. So going back to this. So let's go and play with some others. But before I do, I just want to reiterate again what I'm doing. So I'm taking the rent and I'm using a 5% rule, which is really like this. Whatever the value of that house is, I use 5% of it. That's the unrecoverable cost on a low end. So that's, it just, you could say, hey, my neighborhood, there's unrecoverable costs are actually quite a bit higher. Like maybe I live in San Francisco or something, and I may be using something higher, so 7 or 8. But I'm just saying, to get the party started, let's use the 5% rule and determine, based on the value of that house, what's fair rent. And if I'm below that 5%, probably going to rent it. If I'm above that 5%, maybe I'm going to be looking at buying it. So in this particular case, the rents were considerably higher, $250 on 1,500. So 1,250 versus 1,500. That's actually a pretty good size spread. Not quite 20%, but more than 10. I'm looking at that going, chances are in this particular case, it makes sense to buy it. But if it's not there, then I'm going to have to dig a little deeper. So let's do another one. This is going to be fun. We'll do another one. And I wish, you guys could send in information and say, hey, here's what I'm looking at. And then we could just run the calculator on it really quick to use some demonstrations. So if you want to, in the comment section down below, go ahead and throw some numbers out there, and I'll throw it in the calculator. And I may ask you some questions. But let's just say, so I'm going to do, should I rent or should I buy? Rent or buy? And question mark. And let's say that we have a house that's 500,000 and we could rent it for 1,500. So you're on the coast, you're in a city that the costs are a little bit higher. So we're just going to say versus that. Let me change my color back. I hate the writing in red. So then we're going to look at the down payment again. I'm using 20% down, but let's say we did $50,000 down. And let's say that our interest, because of that, was 4%. So we're going to use that when we do the more complicated calculation. For the basic stuff, I'm just going to say, let's do the 500,000 times the 5% rule. So that's going to equal 5 times 5, 25,000. And then I'm going to divide 25,000, divide that by 12, which is going to get me to, what is that, 2,225, I think it is, 2,225, I think it is. Here, I'll actually use a calculator because sometimes the brain plays tricks on you, right? Divided by 12. Oops, 25. Yeah, I'm probably way off. Divided by 12. So yeah, it's 2,000. That's why you use your calculator, right? Is $2,083 a month. So the actual value, actual cost of buying that house is going to be considerably higher than the 1,500. So I'm just going to say the 2,083 versus 1,500 is pretty clear. It's much, much, much more economical to rent that house. Let's go to the numbers on the calculator. So we just used, here, I'll make sure I got this, $500,000, 50,004. So we have $500,000 purchase price. We put down 50,000. The mortgage rate was 4%. And the rent, what do we have the rent at? Was it 1,500? Yeah, we kept it at 1,500. So clearly we're looking at, it's not even close. You're gonna rent this house underneath this factor too. We can also look at the real value of the home. The real value of the home based off of the rents is between 292,500 and 360,000. So whoever has this, they're renting it for far underneath what it would take to justify buying that home. That maybe they're buying it and hoping that it goes up in value. That's all they're doing. which, or they don't have anything else to do with it. They don't want to sell it. Maybe it has sentimental value, but it's not an economically wise decision. Now the maintenance, I use 0.1. So this is a new build. So this is definitely not going to be a new build under these circumstances. So it'd actually be considerably even more expensive. We put in the 0.35. When you have houses that are 20 years old, you're putting in probably 0.5. You're doing about, the maintenance goes up of what percentage of its net operating income. I can tell you that most investors use 0.5 when they're calculating rule of thumb on a property before they actually see the numbers from an investor. So if I'm calculating this based off a cap rate, I'm calculating this based off of the cash flow on this, I'm looking at this going, there's no way in heck is it worth that. So I'm going to go ahead and rent this one. So everything's telling me on this one to rent. So again, these things can be very, very straightforward, or they can be more difficult. Now let's play with something. I'm just going to make up numbers that are rather bizarre. We're going to see how accurate we are. So I'll use the example of somebody I talked to actually yesterday. And let me see if I can remember the numbers perfectly. I just know that they were like, hey, you know what? I have a house, and in Vegas, everything's gone up. So I'm going to say rent or buy. We're going to walk through the same scenario. They could sell their house, they think, at $1.1 million. And they're like, man, I don't know whether I should rent it or whether I should sell it or go ahead and rent it out. In this particular case, the rents that they believe that they can get were close to $5,000 a month. And the question is, should I sell it and buy something else, or should I go ahead and rent it for $5,000? So I just said, hey, let's do a reverse engineering. Let's do the same 5% rule. And I don't care about down payments or anything on this. I'm just going to say, can we still get to the number to figure out what it should be? And I'm going to say, yes, I'm going to multiply this and divide it by 0.05. I think that's how I'm going to get to my number. I'm going to calculate it. I could just plug it into my calculator too, but let's just say I'm going to do this times 12 is equal to 60,000 divided by 0.05. It's going to get us to right at 1.2. So that's pretty funny. So on the low end, using those numbers, we're getting pretty darn close. So I'm saying, hey, realistically, to make it worth it for that, it would be about 1.2 million. So, you're right in the ballpark at that 5,000, but let's actually use real numbers. I like to use the real numbers so that I can actually calculate. So we had a $1.1 million house. Oops, forgot a zero. 1 1 0 0 1 2 3. We're going to say we don't care about the down payment. We're going to say, what's the interest rate? I'm just going to use the average interest rate right now. And your rent's 5,000. So we start looking at it going, all right, what's the real cost? The real cost of that home is about 6,000. So using their actual numbers, I'm going to look at the house. Let's see, this house was about a 15-year-old house. So we probably are close to the 35. It has not been updated or anything like that. So the insurance, we're pretty spot on. I think that their insurance, because they have a cap on it as to what it would go up. So it might be higher for somebody else who's buying it, but their cost. They don't have a cost of capital, but they do have a lost opportunity. So they're going to be pretty darn close to the real monthly cost of being about 6,000. So if they could rent it for 5,000, they're going to lose value. The investment value, there we go. We could see off of that, it immediately drops to the 675. I know this particular individual is making more than that. So they like cash flow properties in the 6 to 7. So the value of that house gets cut down to 650,000. That's what they're going to pay attention to. So we're going to use this to reverse engineer and say, should I rent my house out? Probably not. Go ahead and sell it and take the money and invest it in something else. Do it like if you really have to, there is a way to do a 1031 exchange under those circumstances if they lived in it. If they haven't lived in it, then it's 1031 for sure. If they've been living in it 2 of the last 5 years, they could get a what's called a 121 exclusion plus a 1031 exchange. You could do both on a house so long as you put it into the rental market for at least a period of time. Or let's say they bought this 5 years ago, husband and wife, for 700,000, and they're going to sell it at 1.1. They wouldn't have any capital gains if they lived in it 2 of those 5 years. So we don't have to worry about that. So they're going to have a little bit of transaction cost, about $100,000 shaved off the top, and they're going to invest about $1 million and be able to get a much better return as opposed to renting this thing out for less than what it's worth. Let's do one more just for fun, because doing these is fun. Hopefully you guys are seeing that it's not always what you think. And let's go to another marketplace. Let's say rent or buy. Let's say that you're in Seattle or something where it's 750,000 is the value of a house, and you could rent it, So the rents, pretend I can write. So rents, let's just say it's 4,000, and you could determine whether this is a good deal. Same scenario, we're going to do 20% down. So we're going to do 150,000. And again, you could plug in whatever number you want. And because of that, we're going to be right around 4%. And our rule of 5% rule is going to tell us, let's say we take our 750,000 times 0.05 is equal to, so let's do that, 750 times 0.05 is equal to 3,750, 37,500. We're going to divide that by 12. So we're going to have $3,750, or excuse me, 3,000. There's 37,500 divided by 12. Let's see if I can speak today. We're going to end up with $3,125. So you're going to say is 3125 the 5% rule versus 4,000. It looks like I might be better buying that house. So let's go to our calculator to see for sure. So we're going to go 750. We were at 4%. So now we know the cost of our money. The down payment was 150. Is that what we said? Oh, you know what? I screwed that up. We want to make sure I didn't do 10% down. That would be 300,000. So it doesn't make any difference on these numbers, but it will make difference in our calculation. Apologize for that. 300,000 down. So I'm going to make that go away. Down payment. So what do we have? We have 450 finance. So the rent, we looked at 4,000. So the rent quoted was $4,000. Let me go back and take a quick look. Yep. So 750,000, 20% down is 300,000. No, I was right the first time. Gosh darn it. So 150,000. I don't know what I'm doing there. 750,000. So 20%, right? I was right. Doing two things at once. So I'm going to put that back in. Maybe you put 40% down. You just went crazy, hog wild. So what are we looking at? So we're looking at the rents of 4,000 a month. 5% rule says it's 3125. Make sure I had that right. 3125. Yep. So are the rents greater or less than? They're in the range. So if it's within the range, I go here, then it's neutral, consult values in C for assistance. It really is going to come down to the cap rate of that area. If it's 4%, then the value pops up, and we're in the ballpark. We're buying it on the lower end. 5% rule value of that house could be as high as 960,000. The investment value at a 4 cap, which is about what the markets are at now in most places where the markets are hot, you'd be at 780,000. So both of those are higher than the price of the home. They're right there. So is about then. So the price of the home is less than those. So is below, then is below all the values there, then you should buy. So we're right there. So we're just right there on the buy factor. The real monthly cost, we're paying just a little bit more if we're being aggressive on the cost factors. Again, I would be looking at the age of this house and how well maintained it is. I'm using 0.35, but if it's well maintained, you could be 0.1 or 0.2, which immediately puts you in a much better setting where the rents are higher. There should be an obvious buy under those. So that's why we use the calculator. It just gives us an idea. I'll probably put criteria on that. So if anybody uses the calculator, they'd be able to tell. And that gets us right where we want to be. That just tells us, hey, you know what? Under these circumstances, I'm going to go ahead and buy this one. There's no value, like we're overpaying in rent. Or you use this as a negotiating point. You say, hey, I'm looking at this and it doesn't make a lot of value, or it doesn't make a lot of sense for me to rent at 4,000, but I could see it really being closer to 31, knowing that, you know, it could be between 3,100 and 3,800. You could go negotiate with the landlord that way. Anyway, so that gives you a pretty good idea of how these things work and whether you should rent or buy. It gives you ranges. Again, in YouTube, you can go ahead and leave me comments and I'll take a look at it to see whether or not, or look at your numbers. And I could say, hey, based on the calculator, here's the range, and be happy to kind of use the calculator on it to see. What I would really need to know is how much down payment, the value of the house, mortgage interest rates that you qualified for, how old the house and the condition of the house. You could just say it's an A, B, or C property, A being great, B being really, really good shape, C being not so great, D being war zone, you know, older house, not much done to it. It's going to need a lot of work. But we can figure out what the maintenance costs and things like that are. And also, if you know if you know taxes and insurance, then we could get it too. And we can break this down for you almost down to the penny, so you can make an intelligent decision. So if you like this type of information, please subscribe and please like this video and share it with others. And we put a lot of information out. Now, this spreadsheet I just created on my own on the fly to help with my clients. And when they're trying to make decisions, especially on values of houses, a lot of times it's just investors, and we're backing it in to see what the real value of a house is, rather than what these things called comps are. Like comps are what retail people do, not what sophisticated investors do. Investors buy on cap rate. So you can make sure that you're not making a blunder just because a house or a market's running up the prices. You can make sure it's related to the actual dollars that would be generated, rather than a competitive marketplace or everybody getting emotional in a marketplace. So that's it. Hope you like it. Subscribe, like it, and leave me some comments down below and give me some numbers, and we'll play with some of those numbers. I'll post them back into the comment section. Thanks, guys.